Hi, good morning. My name is Yasha and I help young men with investments. So today we are going to analyze Lowe's companies incorporated with the stock ticker LOW because this company is actually fairly popular among investors. I know quite a lot of people that are investing into this company, and also there are so many people on YouTube and on I don't know, on the internet as a general that are investing in Lowe's. So let's take a look at it together and decide whether we should also add it to our own portfolio. Okay, now as always, we are going to analyze Lowe's using this little Canva presentation that I have right now here. So let's begin. First of all, why should you even listen to me? So, as you know, my name is Yasha and I help young men with investments. And when you have more trust for me, I invite you to click the first link in the description where I teach you absolutely everything about money and investments in general, okay? Now, let's begin. So, whenever you are a young man who is starting to invest on the stock market, your biggest fear is that you will pick bad stocks and then lose money with them, okay? So that's why I'm here to help you. I will teach you how to analyze stocks as a complete beginner. Just follow my framework and you should be okay. So, whenever you analyze stocks as a complete beginner, you should generally care about the following 6 things. You should care about chart, profit, debt, money on the bank account, value, and price. Now here we have some quick facts about Lowe's. So it's a retail company that was founded in 1921 and they are mostly focused on home renovations, home improvements, just typical store, where you buy stuff. It's that simple for the house. Now here is immediately the first thing that I want you to pay attention to. The older the company is, the better and safer investment in general it is, okay? Because take a look at this example. So Lowe's was established in 1921. That means they are already 103 years on the market. And that means that they survived so many crises. And after so many crises, they are still here. That gives us a clue that this company and its management are good ones because they survived First World War, they survived Second World War, they survived the Great Depression, they survived, the Black Friday, they survived the dot-com crisis, they survived 2008 real estate crash, they survived coronavirus, they survived at least 7 different crises and major crises actually, and they are still here. That tells us that the management is absolutely amazing. So with confidence, we can say that this company might be a good pick, okay? Because whenever you see maybe some startup that was founded last year, for example, for them, we don't know how good the management works under pressure, okay? Because they haven't experienced any stock market crash yet, because if they were established from last year up until now, nothing specially happened, Maybe the stock market went up and down a bit because of the Federal Reserve, but that's it, So, as a rule of thumb, the older the company is, the better and safer investment it is. For me personally, I like to invest in companies that were established between 50s, maybe 60s to 70s. Those are the gold mines, I like them and I recommend you to do the same, okay? Now we come to the chart, and for chart we have an instruction that it has to grow for all 10 years. Now what exactly does that mean? That means that I will draw a little exponential line that grows exponentially, kinda like that. And now we are going to compare the actual stock price chart with this black line, okay? So we will compare the orange line with the black line, and preferably they should follow each other, because if the company grows exponentially, that means that they are more and more profitable, they are expanding the business, they are growing, and they are just overall an amazing buy for us, okay? Now, what do we have here? Here we have literally the exact growth that we want, because as you see, the chart grows quite steadily, and then it grows massively, then it goes down a bit, and then it grows up a bit, So it definitely grows exponentially. This is what we want to see. Now we come to the profit, and for profit we have an instruction that it has to be in plus and it has to grow as well, okay? Now here is the very same story as with the chart. I will draw a little exponentially growing line, kinda like that. And now we are going to compare the profit with this line. And what do we see? Quite an amazing growth, you know, of course a bit down here in 19 and then a bit down in the last year, but generally the graph is growing exponentially. They are making more and more profit. This is what we want to see. So the profit is also amazing. Now we come to the debt, and for debt we have an instruction that it has to be low and preferably it should also decrease through the years, okay? Now what do we have here? Here we have exactly the opposite. Here we have a growing debt, which is what we don't want to see. Because, for example, think about yourself. Would you be happy, would you be relaxed if you would have more and more debt every single year? Of course not, because more debt generally brings more anxiety. You would be a bit stressed, you would not sleep because you would constantly think about the fact how to repay the back that debt, right? And the companies have the exact same mindset and exact same feelings, okay? The more debt that they have, the worse it is for them in general, okay? Because same as you, they have to think about the ways to make the money, they have to make more profit, they have to make better and smarter investments with the resources that they have, which is a bit harder, you know, and it's just stressful environment, okay? So we don't want to see a growing debt, we want to see a decreasing debt, okay? Now there are of course some exceptions. For example, real estate companies are financing their profit with the debt, right? They are buying more and more properties with the debt so they can make more profit. So for real estate company, this would have been an amazing debt chart, okay? But this is a normal company that sells home improvements products, so nah, they don't need more debt, you know? Okay, now we come to the money, and for the money, we literally measure money on their bank account, okay? For example, you are a young man, you want to invest in the stock market, so you have maybe 500 euros that your grandparents gave you, okay, for Christmas or for your birthday. And companies have the very same bank account which we measure, okay? And preferably they should have more money than the costs. Think about yourself again, why should we have more money than the costs? Would you be happy with having more money or less money on your bank account? Of course, with more money, because more money gives you freedom, more money gives you like this calm feeling that you can do whatever you want and it will not affect your lifestyle in any way whatsoever, you know. But if you are constantly broke, then you are constantly thinking about the money, how to make money, how to pay the bills, what will I eat today, and similar things, okay? Similar fucking problems. And the same is with the companies. The less money they have on the bank account, the more they are thinking about the money, and then the more they are thinking about the money, the more stressed they are, the more maybe they also panic, who knows, you know? And if you panic, then your emotions take over, and then you are making decisions based on emotions instead of with your head, which is recipe for disaster, okay? Especially in the company. So, do they have more money than the costs? Yes, of course, you are a smart young man, use your brain. Look, they have plus $8 billion on their bank account. That's absolutely amazing. That's more than fucking governments, you know. Some African country, I doubt that they have $8 billion, you know, with all due respect. I know that this sounds harsh, but if a company has $8 billion, then they are more than settled, you know. They obviously have more money than they have costs. They have positive bank account balance. This is what we want to see. It's that simple. Now we come to the value, and for the value we obviously think about the stocks that are undervalued, okay? We want to invest in stocks that are undervalued with a potential to grow, okay? Now how do we know if the stock is undervalued or not? With two different concepts. The first one is called P/E ratio, and the second one is called intrinsic value, okay? Now, as a beginner, those two expressions might sound a bit complicated, so don't worry, I will explain it now, okay? P/E ratio means price to earnings, okay? We compare the price with the earnings, and then we compare that number with Lowe's competitors and the whole stock market as well, okay? Now, why P/E ratio has to be lower than 15 in order for stock to be undervalued? Because 15 is the average P/E ratio of the whole stock market. And if the stock market is here, obviously we want to have less than 15 for our company, right? So that it is undervalued. Now, is Lowe's undervalued? No, it's not. It's actually P/E ratio is 20, which is a bit higher than 15. So in that case, Lowe is not undervalued, okay? And now we come to the intrinsic value. And intrinsic value is actually a very simple concept, even though it sounds complicated. So intrinsic value tells you the price per share that company should have at this exact moment. But then the current stock price tells you the price that they have per share, okay? The actual price. Now let's take a look at the example. So intrinsic value of Lowe's is 213, okay? Now that means that the price of Lowe should be 213 for it to be a fair price per share. But the actual price per share is 243, okay? Which means that the actual price per share is actually by $30 higher than it should have been. Now, is that overvalued or undervalued? It is it's overvalued because intrinsic value is lower than the current stock price. If the stock is undervalued, then intrinsic value is higher because the price that they should have is here, but the actual price is here, you know. If it's higher than the actual price, then it's undervalued. It's that simple, right? So basically intrinsic value tells you the price that they should have, but the current price tells you the actual price. It's that simple. Now, is the stock undervalued or overvalued? It's overvalued, okay? We don't want that. And now we come to the price, and for price we have an instruction that it has to be below 150 euros per share, okay? Because we obviously are young men with limited budgets, so we don't want to buy stocks that are way too expensive, because if you buy one stock that costs 500 euros and you blow your whole budget on that stock, and then if that stock drops, what will you do? You lost the money. But if you buy 5 different stocks, 100 euros per share, then if only one stock drops, you still have 4 other profits, right? So it's just better. It's just better to buy a bit cheaper stocks that have the potential to grow, okay? In my personal opinion, 150 is the limit. I don't want to buy expensive stocks. I don't want to spend money. I want to make money. It's that fucking simple, okay? Now, Lowe's price per share is $243, which is well below 150, so we obviously think that the price is overpriced. It's that simple. And now we come to the final evaluation, where we are just going to summarize everything that we found out about the company, okay? Now, does the chart grow exponentially? Yes, it does. If you don't believe me, watch the whole video again. So it does. Does the profit grow exponentially as well? Yes, it does. Do they have a decreasing debt? No, they don't. Do they have more money on the bank account than the costs? Yes, they do. They have $8 billion. Is the value under or overvalued? It's overvalued because P/E ratio is higher than 15 and intrinsic value is lower than the current price per share. Is the price per share below $150? No, it's not. It's around 240, I think. So yeah, no. Now, should you buy or sell? In my opinion, you should fucking sell, okay? Because I will tell you something. Even though the chart is amazing, like chart is growing exponentially, profit is growing exponentially, they have money on the bank account, you know? Those are just typical things that we quickly use to analyze the stocks. But then we have to go deeper, okay? And I want to show you something. Look, even though the company is profitable, right? The margins are okay, the profits are fine, they are growing. When we come to the balance sheet, which tells you the assets and liabilities, basically the costs and money that they make, this is where the things get a bit trickier, okay? The first thing that I want to show you are retained earnings. So retained earnings tell you how much money does the company invest back into itself instead of paying it as dividends or instead of using it for other things, okay? So basically how much they reinvest. Now you can see that in the last 2 years, their retained earnings are negative. What does that mean? That means that they are having more money out of the company rather than coming into the company. That's completely unsustainable. That's messed up. That's a fucking shit. And this you can also see here in total equity. That means how much money is just flowing into the company. Now you can see it's negative. That means more money is going out of the company rather than coming inside the company. Same you can see here on return on equity. Basically how much money are they making based on how much money they have, okay? So if you have a 10% profit, kinda 10% is your return on equity. You know what I mean? Think it from that perspective. If the return on equity is negative, that means more money out rather than more money coming inside. It's that simple. Debt to equity as well. If it's negative, then more money out rather than coming inside. It's that fucking simple, okay? That's completely unsustainable business. I don't want to even touch Lowe's because of that. Even though I know they are on the market for 100 years, they have nice profits, nice growing chart, it's very popular, they are raising dividends as well, so if you are a dividend investor like I am, then that's maybe also good for you, but the background is completely unsustainable, so I wouldn't do anything with Lowe's whatsoever. Now, if you want to know more about investing, click the first link in the description. I will teach you all the juicy secrets. Otherwise, click subscribe and join me in my journey to become a millionaire with investments. Do the hard work and see you on top of the world.